Be Wealthy and Smart, episode 1152.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to cover Chairman Powell's first remarks since Friday's Monster Jobs Report and answer the question I've been asked, is now the time to buy? Well, first of all, a little bit of review. Last week, the Federal Reserve raised interest rates by 0.25%, and Chairman Powell used the word disinflation 15 times in his speech when he had used it 0 times in his December speech. So this was obviously something that he was very aware of and focused on. The introduction of that new word caused a stock market rally because disinflation means prices rise at a slower pace. And headline consumer price index, or the CPI, rose 6.5% over the prior year in December after being up 9.1% in July. So part of the enormous stock market returns so far have been due to the belief that peak inflation could be behind us and that the Fed may raise interest rates another 0.25% in March and maybe another 0.25% in May and either pause after March, pause after May, or completely stop altogether. But what has happened has been the best 3-month performance in the stock market in history, and that's not to be taken lightly. Now, in my opinion, much of that is due to short covering, which I talked a lot about last year that I was expecting was going to happen. The shorts were so heavy into the market, betting that it would go lower and trying to actually drive the prices lower. But now with this strong rebound, they've had to cover, and that means they had to buy stock at an alarming rate, which caused this best 3-market performance in history, in my opinion. Year to date, the S&P 500 is up 7.16%, the Dow is up 2.16%, and the NASDAQ is up 13.58%. And some of the performance is truly spectacular, with some of our investments up 22%, 17.9%, 17.4%, 17.2%, 13.6%, 13.4%, 13.11%, 11.18%, 10.83%, 10.66%, 10.24%. These are returns that you would normally hear for a 1-year period. 10% to 22%, those are annual returns, not something that you expect to get in the first few weeks of the year. So this has been spectacular performance. And inevitably, after a big move like this, I get asked, Linda, is now the time to invest? Well, let me just say that after big market moves is not typically a great time to invest because the market wants to pull back a bit and digest some of those gains. Traders will take profits and that will cause the market to sell off a little bit. And that always happens after a big move up, especially the biggest 3-month move in history. So this is something that we anticipate will cause some sort of a pullback. So it's never good to go full throttle after a huge move up, let alone a record move up. But what you can do is buy the dips or buy on a regular schedule. That's what you do with your 401k when you're buying every month, the same amount, no matter what the market's doing, you're buying. And that's called dollar cost averaging, and that's a great way to invest. And if you panicked last year and got out of the market and you're sitting in cash, what you want to do is start buying the dips. And you can decide to do that over a few month period, but you want to buy when the market goes down until you're fully back invested in the market and you're in for the next rebound. The thing about strong sell-offs like we had last year is that the rebounds are so sharp. That's why I don't recommend trying to time the market, because typically people are getting out at pretty close to the exact bottom, and then they want to get back in after a major move up, and they've missed those really strong gains that would have made up for some of those losses that they felt. So that's why, as investors, it usually makes the most sense, if you have a 3 to 5 year time horizon or longer, to just stay in the market and ride through this brutal volatility. It's never fun, it never feels comfortable, but if you have extra cash and the market's down, that's the perfect time to buy. And that's what professional investors who are tremendously successful, like Warren Buffett, do. They wait for market volatility and they buy the dips in a major way. Not only has this been good for the stock market, but it's also been good for the crypto market. And some of the digital assets that we own in the last month are up 71%, 50%, 42%, 38%, 29%, 27%, 16%, 11%. Just in a month. So crypto is still highly correlated to NASDAQ, and as the technology stocks are bouncing back, we're also seeing crypto bounce back. Now let's talk about Chairman Powell's comments today, because these are the first comments that he's made since that really strong jobs report. He was speaking at the Economic Club of Washington, and he said, "The U.S. labor market remains extraordinarily strong. And Friday's monster job report underscores that the central bank has more work to do to bring down inflation." He said, "We didn't expect it to be this strong," meaning the January jobs report, which showed the U.S. economy added 517,000 jobs. He said, "It kind of shows you why we think that this will be a process that takes a significant period of time." Powell went on to say, "The disinflationary process has begun," noting progress especially in goods prices. However, price gains within the services sector remains high, he added. The Fed expects significant declines in inflation to occur this year. However, it will take not just this year, but next year to get down to 2%, he said, which is the central bank's inflation target. While economists said that the January job total was heavily influenced by seasonal factors and will probably be adjusted downward, it was still likely too hot for the Fed's liking. The robustness of the labor market is somewhat at odds with the Fed's efforts to lower inflation. Chairman Powell wants more slack in the labor market because he's concerned that a tight employment situation will continue to push up wages, which could keep inflation elevated. As the unemployment rate rises, workers lose bargaining power for higher wages and households pull back on spending, which tends to help inflation decline. But remember, we found that a lot of last year's inflation was actually tied into the sanctions and Russia and oil prices, which hit the economy very broadly. And with the inflation numbers being lower than they were last year, down to 6.5% in December versus 9.1% in July, we're definitely on the right track. And that's a huge percentage decline for inflation to have decreased. So this whole terminology about disinflation means inflation rising at a lower pace. David Russell, Vice President of Market Intelligence at TradeStation, said Powell is in a wait-and-see mode. He refrained from walking back his disinflation comment. If anything, he reiterated it in a guarded way. Today's comments do nothing to undermine the recent strength in the market. So Chairman Powell definitely is saying he's going to continue to raise interest rates. We know another 0.25% will come in March, possibly another 0.25% in May. And he also said we will likely need to do additional rate increases, while adding that restoring price stability is going to take quite a bit of time and is not going to be smooth. While some measures of inflation have cooled in recent months, Chairman Powell told reporters that officials need substantially more evidence to be confident that inflation is on a downward path. Dave Gressick, Managing Director of Investment Strategy and Research at Aspirient, said the market's doing the best that it can to try to discount two very different scenarios, both of which are really driven by what the Fed is going to do. The scenario is we get a recession or we do not. And it's highly dependent, in the market's eyes, on how quickly the Fed nears the end of its rate hike campaign. So that's probably the dialogue going forward, is people are going to be wondering, are we going to have a soft landing? Will we have no recession, or will we go into recession a slight recession, or will it be a steep recession? We're going to hear all kinds of comments about that. But what we know is that the labor market is strong, the stock market is rebounding nicely, inflation is trending down in the right direction, and that means that we're closer to the end of the Federal Reserve rate hikes than we are to the beginning. And I think that's what the market's really reacting to. They know that Powell's not done, but they don't see that we're going to have the aggressive rate hikes like we did last year. So the market's looking ahead, maybe 6 months ahead, as it often does, and is moving up in anticipation of better days ahead when those rate hikes can pause or possibly be done altogether. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my wealth mentoring podcasts are on my website at lindapjones.com/podcasts. And there's a search bar where you can search for any financial topic you can think of. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.